Hello ma'am, good day. This video is I will going to present my reporting topic, which is Capital Asset Pricing Model or CAPM. So now I'm going to start my reporting na po. So here, the second slide is asking what is CAPM. The CAPM, the Capital Asset Pricing Model, is a model that describes the relationship between the expected return and risk of investing in a security. It shows that the expected return on a security is equal to the risk-free return plus a risk premium, which is based on the beta of that security. Below is an illustration of a CAPM concept. Here, we can see here is a capital asset pricing model. This broken line, we can see this broken line is a beta of the market. And this line, we can call this this is the risk-free rate. And this orange color is a risk premium between 3% and 9%. So, risk-free rate is normally taken as the yield on a long-term government bond in the country where the project or company is based. So now I will going to show you the CAPM formula and calculation. Here are the formula of CAPM. RA equal RF plus BA times RA minus RRF. So RA is stand for expected return on a security. Then RRF is risk-free rate. The BA is a beta of the security. Then RM expected return of the market. So before that, we will I will going to discuss what is the meaning of this what is the meaning of this formula from the CAPM. Expected return means the RA notation above represent the expected return of a capital asset over time given all of the other variables in the equation. Expected return is a long-term assumption about how investment will play out over its entire life. Next is the risk-free rate. The RRF or risk-free rate notation is for the risk-free rate, which is typically equal to the yield on a 10 years US government bond. The risk-free rate should correspond to the country where the investment is being made, and the maturity of the bond should match the time horizon of the investment professional convention. However, is to typically use the 10 years rate no matter what because it's the most heavily quoted and the most liquid bond. And for beta, beta is denoted as BA in the CAPM formula. Is a measure of a stock risk or volatility of returns reflect by measuring the fluctuation of its price changes relative to the overall market. In other words, it's the stock sensitivity to market risk. For instance, if a company's beta is equal to 1.5, the security has 150% of the volatility of the market average. However, if the beta is equal to 1, the expected return on a security is equal to the average market return. A beta of -1 means security has a perfect negative correlation with the market. Then the market risk premium. From the above component of CAPM, we can simplify the formula to reduce expected return of the market minus the risk-free rate to be simply the market risk premium. The market risk premium represents the additional return over and above the risk-free rate, so which is required to compensate investor for investing in a riskier asset class. Put another way, the more volatile a market or an asset class is, the higher the market risk premium will be. So now, for this next slide is the CAPM example. We'll have one example here, the calculation of expected return. Let's calculate the expected return on a stock using the capital asset pricing model or CAPM formula. Suppose the following information about a stock is known. Here, it's trade on the NYSE and its operations are based in the United States. Current yield on a US 10 years treasury is 2.5%. Next is the average access. The historical annual return for US stock in 7.5%. Next is the beta of the stock is 1.25, meaning its average return is 1.25. As volatile as the S and dollar 500 pesos over the last 2 years. So now, this is the question. What is the expected return of the security using the Capm formula? So now here is we can see here the answer and the formula. We can see expecting return from the given that we read above is the expected return or the risk-free rate. No. This is the first is this is the how to say this is the formula of CEPM. Expected return equal risk-free rate plus beta times market return premium. So the expected return is 2.25. So this is the current yield on a US 10 years treasury is 2.25. So this is the risk-free rate. So we will put this here, 2.25% plus the beta. So the beta here is, you can see that's the 1.25. So this is the beta of the stock is 1.25. So we'll put here the 1.25 times 7.5%. So this is the average historical annual return for US stock. So this is a 7.5%, I mean. So when we calculate this, expected return equal 11.9%. So this 11.9%, this is the expected return that the investors will receive after 10 years of na bumalik sa kanya, ganun. So how will paano natin nakuha itong 11.9%? So we can see here, no, 2.5%. So plus 1.25 times 7.5% is equal to 11.9%. So this is expected return, the 11.5%. So that's all my report po, ma'am. I hope I report in a good way, and I hope you will understand my presentation po. Thank you, ma'am. Thank you. Have a good day po. God bless.